Hello, guys, wherever you watching us or listening to us on a podcast platform. He is again Růžička and Kweenolog on X. Hello, guys.
Hello, everybody. And today we have a very special guest from Xianggang, which is Hong Kong. And maybe Honza would like to introduce him because he's a good friend.
And first, hello, Ajay. It's great having you.
Hi, Jan. How are you? It's great to be here.
So we are now running recording between Czech Republic and Hong Kong, as Dan rightly pointed out, and we have Ajayem Kapurem, who is a super skilled Asia-Pacific equity strategic and a macroeconomist that's seen it all. He was a big shot in Deutsche Bank, Bank of America. He's running his own portfolio. He's doing a lot of teaching. He is on multiple times on CNBC, Bloomberg, you name it. He is also frequent speaker at top conferences. So it's great having you, Ajay, to talk about Asian macro, Asian stocks, Asian investments, and how you see the world moving from the place where you are, which is Hong Kong.
Yeah, no, thanks for the opportunity. So, as you said, I'm more focused on obviously following the markets, but running my own portfolio and talking to all my friends who are in the business. I think it's sort of interesting. Maybe just take a step back to what was about to happen last year. 100% of economists said that there'd be a recession. And there were good reasons why they thought that, the inverted yield curve, policy being tightened and so on. And I feel that those indicators obviously didn't work because there was no recession. Actually, the economies in the world were doing okay. Yeah, China was slowing, Europe was slowing. But for all the fear and doom-mongering that we heard, forget about the economy. We ended up making a lot of money. You could actually throw a dart at pretty much any market in the world, sort of ex-China, Hong Kong, and you would have made a lot of money. So the US was up 25%, NASDAQ up 45%, the DAX was up, 20 plus, Japan was up 20, 30 plus. And so this was a raging global bull market. And I understand that some people think it's a very narrow market. We can talk about that. So you got to be very careful when you're talking to strategists and economists that are very confident, because we're often wrong but never in doubt. That's the joke. So where are we this year? I think we're actually in a pretty decent place. I see a lot of the PMIs, the purchasing manager indices that talk about the manufacturing sector. They seem to be bottoming out, and they were troubling all of last year because they kept falling and then they stayed low. So the manufacturing sector clearly was weak. But, oh my God, you cannot rule out the American consumer. And if you think about it, asset markets were pretty strong last year. The property markets in most of the world were pretty strong. The unemployment rate was 3.7% in the US, and the balance sheets are very good. And we had just been freed from all those COVID lockdowns. So forget about inverted yield curves and all this fancy stuff. I think, as one of my clients said, Ajay, you run a lot of sophisticated models. When you're telling me about the weather, how about just opening the window and looking outside and telling me what you're seeing? Yeah. So I think things are stabilizing, bottoming out. I think inflation is falling. And I understand that people have different views on how quickly it'll fall. I'm reasonably comfortable that inflation across the world is falling. And earnings growth is going to be pretty decent, call it 10%. And that's all I need. You don't need to be too complicated in this business. Inflation goes down, earnings go up, markets generally go up.
Maybe my first question, what's your explanation of the current situation that the world economy is in such a good shape? Because there are all the problems around us and we cannot see it in the economic situation.
Yeah, I think, so there are different kinds of economies. So, obviously China, that, I live here, things are slowing down, no doubt. There was a slight bump after the lockdowns finished. So China is a little bit slower, clearly. And that's, I think, a function of policy. So put China to one side. But the European economies have slowed down, no doubt. But I think I own a lot of European stocks, and they are fantastic. You just have to, there's a lot of so-called European stocks that happen to be listed or headquartered in Europe, but they sell to the whole world. So they could be, they could be headquartered in Mississippi, or in Tokyo. It wouldn't matter because their businesses are very global. And the U.S. economy is very special. So as you know, the Biden program of infrastructure and manufacturing capacity, that part is very, very strong. But the biggest part of the US economy is the consumer. It's the usual 70%. And a lot of that is driven by rich people. This is my old theory of Plutonymy, that rich people drive the world economy disproportionately. And so if you're rich, as I said, your stock portfolio has done great all of last year. So you're feeling pretty good. Your stock bond portfolio has done reasonably well. And your house, which is the biggest asset for middle class America, has gone from 250K, pre-COVID to 400K. So if you're one of the 63% of guys who own their own homes in the US, you're feeling pretty good. Your home equity is off the charts. And your debt service is very low because you locked in your mortgage at 3 to 4% pre-COVID. And so 7-8% is mortgage rate doesn't really bother you. And if your companies, you very cleverly, when bond yields are very low, you termed out your borrowing. So, the Fed could raise rates to whatever, 5.5, and it doesn't really matter to you unless you're a small company that has very short duration debt. So I think balance sheets matter a lot. So consumer balance sheets are great. Corporate balance sheets in general are very good. And the asset markets have done well. So I think the fiscal policy was pretty easy. It's getting on the margin a little bit tighter. So I think that's all you need. You can't tick every box. And I'm sure all the professional doom mongers, they get up in the morning and they figure out, how am I going to sound negative and full of pessimism so that somebody pays attention to me? Obviously, we all need to manage risk carefully. We can't get complacent and arrogant, obviously, all the time. But I think pessimism as a philosophy, I think should be avoided. Try optimism. You'll feel much happier.
But still, let's open the box. You put China in, yeah? Let's open the box. China is out. We see a lot of murky predictions for the Chinese economy, especially on a Bloomberg. If you want to see negativity, switch on Bloomberg TV or go on their internet and website. So, but still, there is a lot of problems. Slow economic growth, outlasted economic growth model, real estate, low productivity, demographic, COVID-19, nationalism, and so on and so on. So, what do you think? Is situation that dark as we see?
So look, obviously there are some challenges in China as the country gets older. So we've all heard about the demographics. And just on that, I hear that all the time. I've written about it myself, and I'm not that concerned because it's a big country with 1.4 billion people, and there's enough people around. So the unemployment rate to me doesn't really matter. There's enough underemployed people. There's a lot of, so women in China in a lot of sectors retire at 50. And, the life expectancy is much higher than that. And men retire at about 55 or 60. So just raising that retirement age is good enough. So yes, of course, there's a demographic challenge, but it's not as bad as people say it is. Now, number two is the debt dynamics. Yes, it's an issue where the debt to GDP is very high. We all know that. We've seen those charts, but no one's ever shown me a chart of assets to GDP. Whenever I look at my own balance sheet, I have a lot of debt, but I have a lot of assets too. And so the sovereign government in China is a very wealthy sovereign. They have not just the financial foreign reserves, they own land, they own buildings, they own equipment. And so monetizing that is not a big problem. And it's a country with very low interest rates. So even if your debt to GDP is high, it doesn't matter that much, because the interest costs can be pretty contained because there is deflation there. So I've talked about demography, I've talked about debt, the two usual issues. Now, on property, yes, property obviously is the biggest asset for the Chinese consumer or the Chinese citizen. About 85% own their own house. Many own more than one. And the demand over the next 10 to 20 years just isn't there because of the one-child policy. So, there just aren't that many people who grow up to demand more and more apartments. And that's fine. Many countries have gone through that. And so I think we just shift away from property as an asset to the capital markets as an asset, whether it's stocks or bonds. And that's another discussion. So, I think the valuations for Chinese stocks are pretty decent now. Obviously, when at these valuations, everyone becomes bearish. That's very normal. And so I think all we need is some sort of policy reflation, primarily on the fiscal side. And that's the more important factor. And I think they don't want to do the whole monetary reflation, like, for example, the Fed has done or the ECB has done. They don't really believe in QE, and they don't believe in these blowout budget deficits like you have in the US. 7% in a peacetime, fully employed economy is, I think, pretty impressive. So I think their policy structure is just different, and I think at these valuation levels, to be bearish on Chinese equities, I think is just wrong.
Yeah, maybe they are stuck in a trap a little bit because of their monetary regime. So I mean, capital controls and closed capital account and a fixed currency rate and so on. But you touch the capital markets, and what we can see most from China are the Chinese stocks are falling down like leaves in the high autumn, and what's your opinion on that? Is it only about a sentiment on the market, or is it really fundamental? And should we be afraid of continuation of this trend, or what should do the Chinese government to stop it and stabilize the markets?
Well, so I'm not a big fan, whether it's in the US or Europe or Japan or China or any country, of government stabilizing a stock market, unless it's like a Lehman's crisis kind of day where, the whole system is going to collapse. And that's just not the case in China at all. I think that you make money in stocks when the companies can make a return on equity, when there's economic and earnings growth, and when there is some visibility about corporate governance. And that's sort of it, really. So I think there just needs to be some increase in confidence in the corporate sector. And I think there's been a transition in the way the corporate sector has been run in the last 5 years, in that, if you're running a country and the corporate sector is perceived not to be aligned with the political philosophy or goals of the country, then obviously some change is required and called for. And we're going through that transition period where, China has some great advantages. If you think about EVs, if you think about, cars, you think about rare metals, if you think about solar, wind, I mean, they lead in a lot of this stuff in AI. And I just read recently that Huawei and SMIC are making 5-nanometer chips. So that's a very big deal. And I've done a lot of work in the past sort of 5 years where I think the Chinese scientific advancement has been dramatically underestimated in the West. I mean, China it graduates a lot of engineers, many multiples of the US. The number of scholarly articles they write that are referenced by other scholars, the amount of money they spend in R&D, the defense spending, all of these are very good for innovation. And that's their new growth model. And I think the market is just in this transition where we are all used to the Tencent and Alibaba and, Meituan kind of stocks. And they did very well for a time. But this new wave of innovation-driven growth is what's going to be the next wave.
If we look on China more broadly, so Chinese government is trying to bring in new financial investors. They really try to opening up. We saw Prime Minister Li Qiang with 10 ministers in Davos. He was super boastful about let's come to China, let's make money together. They also have taken several measures last year. There are new foreign players in China now, including from United States, which is what we shall also remind our audience that despite all the noise, Beijing and Washington are still trading like never before, and there are more US companies even now, 2024 in China, and it's not only Tesla and Apple. So, how you think from the perspective of Beijing, what kind of measures they want to do, or what you see on the ground, how to attract more foreigners?
Well, I'm not so sure they need that many foreigners. I mean, this is a country with a savings rate of 40%, right? An investment rate of sort of 42%. So the economy is $17 trillion. So they save about $6 trillion US dollars every year. That's bigger than the Indian economy. So there's a big pool of savings. They don't need anybody's money. They also have 3 trillion of foreign reserves. So it's not like they need some, dollars or euros. And that's why they need FDI or portfolio investment. So that's sort of the first point. They might need the expertise for a short while, but they've been drawing on that expertise for 30 years already. How do you do an IPO? I think Chinese investment banks know how to do that. So how do you do derivatives? They know all this stuff, right? How do you do fund management? How do you do hedge funds? How do you do quantitative hedge funds? It's all there. I mean, they're here in Hong Kong, they're in Shanghai, Shenzhen. So I think what they really need to focus on is the productivity and allocation of capital domestically. Like, what do you do with this 40% savings rate? Because earlier on, it was going to the banking system and then going on to the property market and the local government bond market. Well, that channel is going to dry out in the next 10 years. And I think a lot of that savings, like in the West, has to go into the capital markets. And it'll have to go through the pension system and the insurance system, not just guys punting around. That's a small part. This money, the savings pool, is normally handled by professionals and institutions. And so I think it's a completely different channel. So it'll be more Americanish in that the savings rate is going to the capital market. So for healthy capital markets, as I said those things earlier, you need transparency, you need good corporate governance, you need companies to have some sort of visibility and certainty. You need dividends, share buybacks. So really, capital market reform will make it attractive as a substitute for property, whether it's the individual or whether it's the institution channeling those savings.
And is the reform of the capital markets really happening just now or not?
I think it's 2 steps forward, 1 step back, because I said it's a transition phase and they're trying to figure out like what's important for us. Because, the open market, capital market will allocate money to, a bubblegum factory. And that's fine because that's how capitalism works. That's where the money is and you've got a wide moat and a brand. That's awesome. But in China, you also have a lot of national objectives. For the party, for the country as a whole, self-sufficiency, let's say in semiconductors, it's a big national objective, or low pollution, environmentally friendly stuff. That's a big objective. I mean, I've just given you 2 as an example. And of course, the market's doing a reasonably good job of allocating capital to those sectors. I just mentioned SMIC, Huawei, and so on. And so it's not going to be a complete, free flow capitalistic capital market. That's highly unlikely to happen. I think there's always some sort of guidance. But by the way, it's not just China that does it. So the US does the same thing with this industrial policy. And industrial policy was not started by President Biden. It was started by Alexander Hamilton. So it's a long time ago. That's like in the 1790s. Or this report on manufacturers.
Okay, you sound very optimistic about China.
Well, I don't want to color it sort of super optimistic, but I just I've been around a long time where I think I look at a valuation chart and it's like at a 25-year low. To say you're pessimistic is like, thanks, buddy. You should have told us like 2 years ago. That's what I would tell guys who would, at the lows become very pessimistic, and at the highs on a valuation chart become super optimistic. So I just think it's risk management that, you want to be careful at these low valuation multiples. You really are making a bet if you're still bearish that the policymakers are going to do absolutely nothing. They're not going to try anything, and so on. So, these things, as we know, go in waves. When all the foreign brokers, have left a market, that normally marks the bottom.
Maybe on this, and I think that you already answered it, but maybe let's go more deeper. So if there is one big common headline about China now in some let's say long-term outlook, it's middle income trap. Middle income trap is big thing everywhere. Normally, we would say, and this is how you already answer it. It shall be combination of productivity of innovation. On the other side, some fundamentals are against China, especially demographics, social cohesion, some welfare spending that surely needs to be, upgraded big time because of aging population. So, how you see this divide? Some fundamentals on one side and the productivity bringing China one day from this middle income trap problem?
I think it's, as you said, very few countries have escaped the middle income trap. So Korea, Taiwan are two examples. Israel maybe another one. Czech Republic maybe another one. So there are very few countries that have escaped this. And those are generally, they're not as big as a 1.4 billion people country. So, if China escapes the middle income trap, I mean, it's going to be a massively, dramatically wealthy country by definition, right? If you take $40,000 per person multiplied by 1.4 billion people, that's a gigantic economy. It's already pretty big. So I think the answer is pretty straightforward. It's going to be very, very challenging. I'm not concerned about this demography stuff that much. I was saying earlier that you need to just raise the retirement age for women from 50 to 65, like in most places in the world. For men, you can raise it again because the life expectancy, and all of a sudden, so in other words, I haven't heard that in China that, oh my God, we're running out of people to work. Like, I have not heard that ever, and I don't think I'll hear that for the next 20 years. They're not going to run out of able-bodied men and women working very hard. I think it's more the quality of the workforce, which actually is pretty good. If you look at the tertiary education levels, they're very high. And as I said, you don't need 1.4 billion smart people. That's not the way it works. It's the Pareto principle. Like 20% of any group drives 80% of, this is Pareto's principle of the productivity. So you need 20% of the country to be very smart, very educated, with access to capital, ideas, knowledge, money, to drive things forward. And so it really is it's what my friend Louis Gave calls, you've moved from sort of Ricardian growth, which is put lots of people together with capital equipment and make them make sort of shirts and export. Whereas now it's Schumpeterian growth, which is all innovation-driven growth. Because the move from countryside to the towns and cities is kind of done. And I'm not so sure the West is going to absorb as many exports from China as it did in the past. So the whole, currency devaluation, let's export to these guys in the West. I just don't think that's a viable option for them. They know that. And so they need to raise consumption and raise innovation. And it's still going to be a challenge. But at this point, where you get to, when you think about the three countries I talked about, right? Korea, Taiwan, Israel, they're all innovation-driven economies. They did the whole let's export low-end goods, textiles, toys, all that stuff, devalue every now and then, blow up the economy every now and then. But then what really got them to the next level was innovation. And that innovation was driven by some gigantic companies with a feeder base around them.
Yeah, and China has already started, innovate, of course.
Yeah, I mean, it's the reaction from the U.S. to China on cutting off semi equipment, various kinds of intellectual property, obviously means that they've assessed that China has made dramatic progress on many fronts. I think military spending is a very important driver of innovation, and so no one really knows what countries spend on defense. CIPRI in Stockholm publishes some numbers, but I mean the actual numbers for most countries are much higher. So I think in China the official number for defense is like 250 billion. US is about 800 billion, but who knows what the actual numbers are? And so there are a lot of cutting edge research is done in the defense industry. And I think that's going on, quite dramatically in China and in the rest of the world. Less so in Europe, but certainly in the US. So.
Yeah, maybe the last question to China would be concerning Evergrande, because Hong Kong court decided to liquidate this company. And it seems to me that the problem, especially in the media, is a little bit over-exaggerated. That the real estate problem in China is happening about three years. They are trying to cope with it. So this is nothing new. And I suppose that media do not inform about it in a good way. So what's your opinion on this decision? Is it important at all in this situation?
Well, it is very important because it is the biggest developer with a lot of overseas dollar debt. And it's obviously been very painful for those foreign debt holders, a lot of them who are high net worth people in Hong Kong, who bought this debt on a levered basis because the yields were so good. And so I think it's important to see how this stuff is resolved, who gets the assets, which creditors, what is the creditor committee, how are the funds dispersed between domestic debt holders and foreign debt holders. Is this a template for other developers? Because that is a very big sector in terms of Asian debt issuance, especially offshore. And so I think it's important to see how that develops. But as I said about the real estate sector, I think everybody knows, even in China, that it's not a growth sector anymore. There just isn't that much new organic demand because of the demography part. And so it's just it has to be, the question is that when there's so many defaults as we've seen, who's taking the default on the other side? Is it bondholders or is it the banks? And if it's the banks, I haven't really heard any stories of stress, etc., in terms of these defaults, bad loans impairing the capital, because that's when it becomes a big problem. But I just haven't heard that. So if there's so much debt that this sector took on, if it's in the markets, if it's just through bond issuance, and obviously bondholders lose, that's fine. That's a market clearing situation as long as it doesn't infect the banking system, so the credit multiplier doesn't collapse. So if that happens, then that obviously is a concern. But I haven't really seen any evidence of that.
If we a little bit zoom out from China and go a little bit south, the bridge between ASEAN and China is Hong Kong. And, throughout the whole COVID and even now, there is this big competition between Hong Kong and Singapore. What's number one financial center in the region? I love Hong Kong. You both know I do. I still believe that nowhere else in the world you have a combination of megalopolis, mountains, and the sea. For me, it's the best city in the world as a city. But still, really, even a little bit before COVID, but now definitely we see Hong Kong a little bit losing, not only to Singapore, but also there is a Shanghai Stock Exchange, there is a mainland market. So how you see this competition between the two cities?
Well, I think, people have, I've been here since 1992, so a long time, and I've seen many stories writing off Hong Kong. And they're all bogus. I'd never believed any one of them. I think people are generally envious of Hong Kong. As I said, they're pessimistic. Pessimism gets you a lot of attention. But I think the value of Hong Kong, apart from the location, etc., is the people here. So Hong Kong is a city of refugees. This is a very important point, right? Almost everyone here is a refugee or a descendant of a refugee. Whether you came in the 1850s, whether you're Scottish or whether you're Parsi, these are the guys who kind of set up Hong Kong in the 19th century, or the various waves of people that came here from China during various disturbances there, or the various expats. And I think the expats are also kind of refugees from their own countries. Obviously they've come willfully. They weren't kicked out, but there's a certain dynamic, there's a certain hunger and ambition amongst the people here. Now, I understand that, the world media makes a big pessimistic sort of story out of this, that people are leaving. That's just nonsense. I mean, Hong Kong has this talent scheme, and a lot of the new visas are being given to very, very smart, educated, and talented mainland folk. In any country with 1.4 billion people, a lot of people want to come to Hong Kong because of our taxes, just the wonders of the city that you mentioned. And so there is some substitution of sort of global expats. And instead of that, you're getting more and more exceptionally smart and hungry, mainland nationals. And so I think the role of Hong Kong is going to be a conduit, a center for the Greater Bay Area. So there's 11 very large cities in southern China and Guangdong primarily. So whether it's Shenzhen or Macau and Zhuhai and so on. So there's a lot of business that's going to be done here. I just think the kind of business, the kind of players are going to change as they have over the last 150 years, right? So I think it's a very flexible, dynamic place and with very dynamic, aggressive, hungry people. And I think that's what makes this place tick.
Yeah, only for our audience, you're talking about Greater Bay Area, in fact.
Yes, Greater Bay, yes, exactly.
Yeah. That's only a note. And maybe when we stay at Southeast Asia region, this is currently the most dynamically evolving region in the world. At least the economic growth is the highest in the world. So did people in this region found the right keys to economic success?
Yeah, I mean, first of all, it's a very diverse region. You've got a big country like Indonesia, which is a democracy. You've got the Philippines, and then Malaysia, Singapore, the city-state. So they all have different business models given their size and endowments. Yeah, of course, they've done very well. I mean, Malaysia used to be a part of the emerging market index back in the late 80s. It still is, but it's a very small part. It's a kind of quasi-developed country. So I think they've done well economically, no doubt. But again, for the stock market, it's not been that great. Because it's a slightly different story that countries can do really well in terms of the economy, but the stock market doesn't have to do well. And emerging markets are a classic example of that. So if you think about all of Southeast Asia, except for one or two, there's no great company that's come out of Southeast Asia. They're good domestic brands for sure, but there's hardly any that I can think of, unless you're in a commodity business, that's become a regional brand or certainly not a global brand. And so I think that's a challenge. So economic growth hasn't really translated into stock market returns. And so to me, if you want to make money in stock markets, you got to look less at the economy. You got to look more at the bottom-up companies. Are there a lot of compounders there? So the best market, for example, in the last 30 plus years has been the US. $1 million invested in 1992 is now about $9 million. That's pretty good, 9 times your money. And then it is Denmark, and then it's India. In all these 3 countries, you made between $8 to $9 million from your 1 million 30 years ago. And the rest are not that impressive. And Sweden's also pretty good. But there's no, apart from India, there's no emerging market in that list of the top 10, even though the economies have become gigantic, right, and have become much richer. And the reason, there are 2 answers to that. One is that a lot of the Americans and the Indians don't dilute you. In other words, they don't issue too many stocks, too many new shares, right? And their earnings per share is decent, like 8 to 10%. And the net income is very similar. Whereas in emerging markets, your earnings could be plus 14% per year, but the share count, the number of new shares that keep getting issued every year, which is good for investment bankers, is so high that your earnings per share is basically close from 0 to 5% per annum, which is your long-term growth rate of your stock market. So you can't dilute your shareholders with that impunity and expect the market to do well. And then secondly, you need a lot of compounders, and compounders are companies like let's say a Google or an ASML, where you have high returns on equity, you have a strong earnings and sales growth, reasonably strong, and that you put a lot of money back into the business, reinvest, and if you can reinvest and still maintain the return of equity and the growth, well, you're magic. And so the country with the highest number of compounders is the USA, right? There's a list of like 50 companies that I can come up with. Europe has a lot of compounders also. That's a key point, where people keep talking about the sclerotic continent and they don't grow and they have all these issues. But There's, I can name like 10 European companies right now that are awesome.
Name them.
Oh, well, let's see. I think, I think the ones that I'm going to name are pretty reasonably standard. So if you think about ASM, there's two right there in the semiconductor business. If you look at, I think Novo Nordisk is now very well known. Everybody knows, but this stock has been doing well for 20 years, well before Wegovy. That's what I think people sometimes forget. It's not just about Wegovy. It's a diabetes medicine provider. The world is very long diabetes. So you have obviously the luxury names in France and Italy. Not all of them are great because I only like very high luxuries. So that would be like an Hermes, or it would be Bruno Cucinelli, or it would be maybe Ferrari, things like that. So I've already named sort of 7, 8, right? And then there's a few others, maybe in Switzerland, maybe in France, in like the industrial space in Sweden. So this not that well known. They make ball bearings and stuff. So yeah, but these are mainly they're global companies. That's important. They're not local.
Exactly. This is probably a big mistake when you invest in Europe and you see the European stock markets and stock indexes. So you find there companies that have headquarters in Europe, but their revenues come 70%, 80% from the world. So exactly. That's you don't invest in Europe, but in the world, in fact.
Precisely, exactly.
Maybe, and you already mentioned it, we cannot talk about Asia without mentioning the biggest elephant now. Literally, which is India. Most popular country for the first time ever, surpassed China last year. India is bold and bullish. We see it in politics, Narendra Modi and Bharat and Hindu. We see it in economy. We see it in growth. You mentioned Indian stocks going to the moon. So, and you are globetrotter, but you are original Indian. How you see India, how you see the business there, how you see, this big story, India becoming new China.
Yeah, so I'm a proud, passport-carrying Indian. You can see the painting behind me is my father's regiment. You can see him right there, right on the horse. It's the Indian cavalry. I think, so as I said, even in the past 30 years, India has easily been the best emerging market in dollar terms. And so we could have been having this discussion 25 years ago, and we might not have been as bullish on India, but the market went on to do very well. The economy also did very well. And it's those two reasons that I mentioned earlier. India has a lot of compounders, like a lot of compounders. If you look at the list of compounders in all of emerging markets, like India has 80% of them. That's a big number, right? Because it's only 15 to 17% of the index, but it has 80% of the compounders. So China has some compounders, but they're not very persistent. They come in and out. They compound for a while, and then there's too much competition or something happens and they leave. And to your question on ASEAN, like I couldn't find a single compounder there, like not one. Latin America, maybe 0 to 1. Japan is a few, quite interesting, and then Australia has a few. So India has a lot of compounders because capital has always been very scarce there. So when something is scarce, you use it very carefully. You make sure you have a good return on equity. You reinvest in your business. And some of the brands, this is the sort of the Lindy effect, that the longer you've been around in the past, the longer you're going to be around. And so some of the Indian brands are 100 years old. These are multinationals that have, or even domestic companies, and the Tatas, they've been around for 100+ years. So they're going nowhere, and they've obviously figured out through, world wars and depressions and different, political environments, how to deal with the system. So a lot of compounders, and they don't dilute. The Indian corporate sector doesn't dilute you, unlike some of the others. So those two are the main ingredients of why that market is good. The rest of what you talked about is just icing on the cake. And yes, I'm quite bullish on the economy. But as I said, I could be bullish on an economy and the market still does nothing. So if the economy does well, that helps the growth rate of the compounders, because even a fool should be able to make money in a country that's growing 10% every year, right?
I totally concur on the compounders in India. I will mention just one from my beloved healthcare. I got a pleasure and honor to know personally Cyrus Poonawalla, founder and owner of Serum Institute of India. For our audience, we in the West believe that the largest vaccine company in the world is GlaxoSmithKline, which is not true. Serum Institute of India, based in Pune, a little bit close to Mumbai, it's largest 2 times. So by far the largest vaccine company in the world that saved millions and millions of lives throughout its existence has been built by the horse breeder. When I see the horses behind Ajay, so Dr. Cyrus Poonawalla used to be a horse doctor. But he successfully switched. He built company out of nothing. And if you see, and I saw it personally in Pune, his factories is state of the art, like in Sangaland, like in Cambridge, Massachusetts. It's really like top-notch company. And as Ajay said, he's been here for 50 years, and he's definitely not finished.
No, exactly right. And I think they did a great job, and for humanity during the COVID crisis. So, in 4 or 5 years, India is going to be the 3rd largest economy in the world. It's right now number 5, and it's probably going to get ahead of Japan and Germany, and then be behind the US and China. And that'll probably go on for a while. But I think India can compound GDP growth between 6 to 7% for the next decade or two, because their economies of scale, increasing returns. As I said, I believe in the Pareto principle that 20% of a population kind of drives the whole thing forward. And then, the taxation system redistributes that growth to everybody, hopefully in a fair way. And so, India has the infrastructure is what people used to complain about. But boy, you go to India now in some, remote city, the airport is brand new and it's beautiful. And one way I look at a country's efficiency is I look at how long it takes for your luggage to arrive on the carousel. And I think India is easily number 1. It's amazing. So whether it's roads, airports, ports, the infrastructure is getting really good. The education system, I went to one of those elite schools. There was only 3 or 4 at that time. This is the IIMs, and now they're like 20 plus. The IITs at 20 plus. So again, it's not enough. Obviously, India is quite poor in education as a whole, but again, it's a big country. So that'll take time, and it'll keep coming because the private sector is getting better in education. So yeah, and the savings rate is pretty high. I get this. A lot of people say, "Oh, the savings rate's not very high," and I said, "Well, what do you want? It's 32% already. Korea and Taiwan and China had 45." And ran massive surpluses with the rest of the world, which the world will not tolerate. And that time you guys worried about overinvestment. Oh, you guys oversave. So look, economists will never be happy. It's just the way economists are. You show them something perfect, like a Picasso painting or a Monet. They'll find like 16 things to complain about. So you got to be very careful about all this, manufactured pessimism, because it seems to me their objective is they get up in the morning and say, what can I find to complain about? So yeah, I was an economist a long time ago, and I've shed all that pessimistic stuff.
Okay, it sounds very interesting, but we don't have more time. We have to finish now. And maybe the last funny question. We come back to China again, and the Chinese New Year is coming. Yes. So how are you preparing for the Chuntie or Spring Festival celebrations, and do you like that?
I love it. So normally, when I was working, obviously I would go away because it was a holiday and you had to make the best of the holiday. But for the first time in, more than a decade, I'm actually going to be in Hong Kong, and I'm going to watch the fireworks from the Carlyle Club, which is above the Rosewood Hotel. So it's got the best view. I've already got my reservation. So I'm looking forward to that with some champagne. And yeah, I think it's going to be awesome.
Thank you for your time. It was great having you, Ajay, and see you soon in Hong Kong.
Thank you so much, John. Take care. I appreciate it. Thank you.
Thank you very much. Bye.